June 6th, 2024. Keep in mind that coming into today, after a small pullback bull trend day, there was only a 25% chance of a follow through bull trend day, 75% chance of 2 hours of sideways to down trading starting by the end of the second hour, and 50% chance of some sort of follow through buying on the open, which you could argue was 2 to 3. And whenever you get bars like 2 and 3, you think 60% chance of a measure move up. Whenever you get 4, 5, and 6, you think 60% chance of a measure move down. But I think this is a prime example of why that is not always the most useful statistic. Because when you're looking at this, if you think about it, we did get that 60% chance. If you sold the close of 6, you can see we got a measure move down. The market was paying attention to it because we got that's basically exactly where the 39 low was the measure move down from 4, 5, and 6. But if you sold the close of 6, you're probably not sitting through all of this for the measure move down. So oftentimes it's going to be really difficult to sit through and make money off of that 60% stat. So, when you're looking at a bar like bar 6, I think it's reasonable to think, okay, 60% chance of the measure move down to 4, 5, and 6, but probably going to be a deep pullback and really, really difficult to sit through if you're going to sell that close. So a lot of traders prefer to sell a pullback if they're even going to sell it. Anyways, bar 1, a bear bar, but a big tail on the bottom. Not as good as it could be for the bulls. They wanted to see a bull bar closing on its high and get some sort of follow through buying on the open to increase the odds of their bull trend day. Bar 2, you can see we triggered above the high 1, which was bar 1, but I don't really want to buy above bar 1, and I don't really want to buy above the follow through on bar 2. It's, we're always in long, and it's a bull bar closing near its high. So is it the worst thing in the world? No. But again, a lot of trades in the open are going to be scalps. You usually don't get the swing on bars, 1 through 4 or 1 through 5. Most of the time, you need the market to give you a couple of bars of information before you start taking swing trades. Bar 3, consecutive bull bars. So good for the bulls, 2, 3, probably going at least a little bit higher, probably going to get at least a second leg sideways to up. But I'm not sure how much higher we're actually going to go. And, on a smaller time frame, we did actually get the second leg sideways to up. If you look at bar 4, what ended up happening, if you highlight the 50% pullback around here, I think traders, I'm not sure if they bought the 50% pullback. I don't remember exactly. They might have just bought below bar 3. Okay, so they bought probably more like below bar 3. But you can see right here, we ended up actually getting a bounce back up towards the high. And instead of buying more and hoping that we go higher, what did traders do instead? They ended up scalping out of the trade. So traders bought down here, and then they just scalped out during bar 4, and then that's what caused bar 4 to close somewhat near its low. So some traders might argue that we did get the second leg. It was just in the middle of bar 4, but I think still overall likely chance that we're going to get a second leg sideways to up. Bar 4, a bear bar, it triggers the low 1 short below bar 3. Some traders would argue it's some sort of parabolic wedge, 1, 2, 3 from yesterday, or 1, 2, 3. I think this makes more sense here, but I just don't think it's all that great of an argument for the bears, so I probably would not sell below 4. Additionally, bar 3 is a magnet because the traders who bought the close of bar 3 should be able to scale in lower and make money. Whenever you have a reasonable buy the close entry like this, there's a 60% chance that we're going to test back to this close at some point later today, and an 80% chance that if you take the buy on the close of 3 and you add more above some other bar, that you're going to be able to scale in and make a profit or get out around break even. So a great example of that was if you bought above 53 today, which I thought was a really reasonable trade, and you added above 57, you can see the market stalled right at the 62 high, which is the midpoint of those two. So you can buy above 57, as crazy as it sounds, an 80% chance that you're going to end up getting here because the traders who bought above here should be able to scale in and make money. Now, there is one other factor with that, is that the bar 54 traded above bar 53, which made it more likely that more traders were trapped, so more likely that we were going to get some sort of rally back up to that price. You can see we did not trade above bar 3, and we did not trade above bar 11. And those were the other obvious magnets of the day. But since we didn't trade above them, they weren't quite as likely to get tested. But I still thought it was reasonable to think, I was pretty surprised we didn't end up getting a test back up into this area. And we probably will end up getting one at some point. So bar 5, a bear bar, tail on the top, tail on the bottom. It's not as good as it could be. It's consecutive bear bars, but you can see big tail, big tail, big tail. So this really isn't all that ideal. And additionally, 2, 3 consecutive good bull bars, and then reversal. 4, 5 potentially consecutive good bear bars, and maybe a reversal up on 6. Obviously, we didn't get it. We got a big bear bar closing near its low on 6. But look at the tails, right? And the reason the tails are important is because it means on a lower time frame, it looks more like a tight channel, which looks more like a bull flag rather than a strong bear trend. A strong bear trend, or this on a higher time frame. So just look at Wednesday on I don't know, we'll look at like a 30-minute chart or something. You can see it looks a lot stronger, and there's there's little open gaps, but no, this isn't the best example of what I'm trying to say. But I guess my overall point is that when you see these tails, like big tail 5, big tail 6, shows there's some buying within bar 5 and within bar 6. And those are little pullbacks. So when you're getting a bunch of little pullbacks within the bar, it means that it's not quite as strong as it could be. So ideally, you want strong bear bars closing near their low, like 55, 56. Obviously, you want better context than 55, 56 was. But those are ideal bear bars versus, 6 is a really good bear bar, but the tail is not ideal. And the tails on the top and bottom of bar 5 are not ideal either. 7, a bull bar, but a big tail on the top. Am I buying above 7? I probably would not. I think that it's better to wait. We've had pretty dramatic moves on bar 7 recently. I think that for the bulls, they could argue it's a high 2. The high 1 would be bar 1, and the high 2 would be bar 7. But it's really not all that great. I think that most likely we're going to end up going relatively sideways here. And then bar 8, you can see a doji bar. So it's follow through if you bought above 7. But if you bought above 7, you were at a loss, even though you got follow through. And that's really never ideal. Bar 9, a bear bar. It's a bear doji bar. I think that 7 and 8 are strong enough for their own second leg up. And 4, 5, 6 is also strong enough for a second leg up. Second leg down. Do I want to sell below 9? I probably would not. I think it's a low 1 short. And the best case for the bears is it's a low 1 short in a bear trend. And even if it's in a bear trend, we're probably going to get a deeper pullback. Low 1s and high 1s in trends generally lead to deeper corrections before they lead to trend resumption. So if you're selling below 9, you probably have to sell more above 9. And again, you have another problem. If you sold below 9, you're looking at the bar 6 close. The bar 6 close is a really important area because that's where bears sold the close and they got trapped 7, 8. And so they're going to be looking to get out around break even if possible. If you sold the close of 9 or they sold the close 6, I haven't checked this yet. 9, you sold below 9. You can see it went back to basically your entry price, and that's where the bar 10 reversed up. Do you buy above 10? You probably can. I think 2 and 3 are reasonable enough magnets that you can make an argument that you should buy above 10 and try to get up to here. My problem with buying above 10 is you're buying in the middle of the trading range. So ideally what I wanted to see was a wedge, bar 1, bar 6, and then maybe like bar 12 somewhere down here, and a reversal up from there, and then we get the move up to here. However, if you decide what you want to see in a trading range, you should automatically think that you're not going to see it because that's usually how trading ranges work. Bar 11, a huge bull bar closing near its high. It's really good for the bulls and it's really strong. It could be a second leg trap, 1, pullback 2. And I think one of the problems buying above 11 is your risk is really huge. So, and your reward, there's probably going to be some sellers around the 3 close. So it's hard to take the buy above 12. I think the buy was more above 11. I think the buy was more above 10, if anything, but I still don't think it was all that strong. Bar 12, when we were about 30 seconds into bar 12, the market was testing around the bar 10 high. And a lot of traders will take that trade where if you're really early in the bar, you're only 20%, 10, 20% of the way through the bar, and it's testing down after a really strong bull bar. Traders will buy the close or buy as the market's falling at a logical support area, like maybe the high of bar 10. Since it was reasonable to buy above bar 10, there's probably going to be traders who, let's say they sat out about bar 10 and they saw 11 and they thought, oh, dang, I really want to be in this trade. And so as the market's coming back down, they're going to set a limit order here to look to buy. Now, when those traders do that, they're looking to do one of two things. They're looking to either buy and have bar 12 become a bull bar closing near its high. If that happens, they might scalp a piece and look for a swing. Or if bar 12 ends up being some sort of bear bar, a lot of the times traders will scalp out. It would be pretty rare for 12 to close on or near its low, but if it does close on or near its low and you entered at the 10 high, you're probably only losing a point or two. And the majority of the time, you're going to be able to make at least a scalp doing that sort of strategy. So the traders who bought the 10 high, you can see what they did. It's visible on 12. They wanted 12 to turn into a bull bar. It had 4 minutes to do so, and it never quite did. So what they do, they got disappointed on the close of 12 and said, I got 1 or 2 points. That's good enough for me. And they exit the trade, and that causes 13. Would I sell 13? I would not. I think that even though 6 is a magnet, 2 and 3 were really credible magnets, and you still have 11, which is really big. And I think, this is probably the dominant feature of the day, but this is really important as well. So I probably would not sell 13 on the moving average. Also, because look, we got to close below the moving average on 6, which is really good. But the bulls are continuously buying the moving average. So it's difficult for me to want to sell a bar like 13 when I know that bar 6, while a magnet, is not as strong as the forces above. Bar 14, it did something interesting. So if you do take a trade like 13, it's probably not a trade where you sell the bar or you sell below 13 and you just see what happens. It's more of an active type of trade. So why is this a bull bar? Well, the reason is for the first minute of bar 14, it was just kind of sitting around down here. And when that happens, what traders will do is, you can see this is it, right? So this is traders sold basically the equivalent of below this bar. And then they got this bar right here that was just sitting sideways. And this bar it's 14 labeled on this chart too. So I'll just show right here. It's a bad follow through bar, and it was a doji bar. And so if you took a sketchy trade where you knew you probably weren't going to win, what did traders wanted to see? They wanted to see bar 14 trade well below 13 and basically collapse below the low of the day and close somewhere down here. They wanted to see just basically bar 6, maybe even without the tail. They just wanted to see a huge bear bar start to form. And instead, the market stalled on 14. So what do? Instead of waiting to get stopped out, they just buy back their shorts at the market around break even. And if the market starts to go down, then they can just sell again later. And if it doesn't start to go down, then it's not really a problem and they're out of the trade. So some traders only give the trade a minute or so before they exit on trades like bar 14, where you're selling right on the moving average where there continues to be buyers. Bar 15, a bull bar closing near its high. Am I buying above 15? It's a triangle, 6, 10, and 15, and 3, 12, 15. So it's a triangle, and you're betting on an upside breakout. And yesterday was pretty strong. We're probably going to continue sideways for a little while because of, after a strong bull trend day, you usually go sideways. But I thought it was a credible buy at the apex of the triangle, considering how many times the bulls had bought the moving average, the fact that we're probably always in long. It's not that clear, but we are probably always in long, and the risk is relatively small. So are you buying above 15 thinking you're going to get a big swing? No, you're probably not going to get a big swing. You're probably going to lose the trade. But I think it's a credible swing trade to take the buy. And, if 1 out of every, I don't know, probably a 40% trade, I would imagine, that you're going to get some sort of move up. But if you do start to get a move up, you're probably at least getting here, and the daily range might double to the upside, maybe somewhere up here. And if you get that, you're making at least, so you're risking 3 points. So even if you get to here, it's not quite 2 to 1, but if you get double, it's like 5 to 1. So I thought it was pretty reasonable to buy above 15. It's just that it was not a very high probability trade. 16, a doji bar. It's technically follow through for the bulls, but it's not the follow through you want if you bought above 15. You wanted to see a bull bar closing near its high, looking something along the lines of 11, 3, or 3, something like that. And instead, you got a doji bar. So it's technically follow through, but it's kind of trading range follow through, where you're going to get relatively disappointed a lot of the time. So what happens, right? If you buy above 15 and you see 16, that's not the follow through you're looking for. So a lot of traders just exit at the market, and that's what causes 17, the big bear bar. And where did 17 test? Take a guess. 6 close, right? Because the bears who sold the close of 6, they scale in higher. They use the sell off on 17 to exit. 18, a bear bar closing near its low. The bulls, I think, see some sort of second leg trap. So we had this, which deserved, second leg sideways down. Some traders would argue we got a 2-legged pullback and then a complex second leg, 1 pullback 2, and this is the second leg sideways to down. Bears are hoping, that this is going to be essentially a swing trade, and we're going to get a move down to at least the high of this bar where bears got trapped. But I don't really think selling below 18 is all that great. I'd rather see what 19 looks like. Whenever you get in this sort of environment, you have to be thinking trading range. And when you're thinking trading range, what you should be doing is buying small bars near the bottom or selling small bars near the top and taking quick profits. It sounds simple, but it's very hard to do, because especially when you buy a small bar near the bottom and the market races up to the top, it's really hard to just take profits and accept the fact that it's probably not going to continue, because sometimes it will, is the thing, right? And so if you buy that small bar near the bottom and then the market races up to your profit target and you take profits and it continues, you're going to remember that. And then the next time you're going to do the incorrect thing. And so it's very hard to make that adjustment. So 18, a bear bar closing near its low, but I would rather wait and see if 19 is another breakout bar. I want to see a breakout below bar 6 and follow through if I'm going to take some sort of short here. Instead, you get a reversal up on 19, but 19 can't close on its high. Had 19 closed on its high, I think it's a credible swing trade. However, it's still a wedge, right? Bar 1, 6, and 19 with the overshoot on 6. But 1, 6, 19 is still a credible wedge, but closing near the moving average and a big tail on both sides and a relatively big bar. So what is this wedge good for? Probably 2 legs sideways to up, which we do get. 22 is the second leg sideways to up, but you have to know what your expectation of the trade is. So it doesn't really make a lot of sense to buy above 19, because your second leg sideways to up is not going to be all that great. 20, follow through for the bulls, but really not all that ideal. You're not closing very far above the entry price and not even on its high. 21, disappointing follow through, an inside bar for the bears. It's okay. I think, it's kind of credible to be long or short, but I wouldn't really, and I think flat is the best. And when flat is the best, that means probably there's an incredible argument for both sides, which I would agree with. For the bears, they've had pretty strong moves, 4, 5, 6, and we still should get that measured move down. And the bulls see this L as a leg in a trading range, and that we're probably towards the bottom of a trading range, which I think makes a lot of sense as well. 21, it's a high 1 for the bulls in their new bull trend from the wedge, but it's a bear bar, so it's not very good. And it might just be the start of the second leg up, which 22 was that second leg up. 22, maybe a low 2 short at the moving average, but a bull bar, I don't want to sell. I'd rather wait for some sort of consecutive bear bars closing near their lows. 23, a bear bar, but a big tail on the bottom, tail on the bottom. And, we're probably not going much lower. This all has looked like a leg in a trading range. I don't want to sell 23, but if 24 looks like 23, then I might consider selling. But instead, you're going to get a disappointing follow-through bar on 24, which is, again, relatively expected in this environment. 25, probably buyers not too far below 24, scaling in, trying to get back to the 24 low. So they buy below 24, maybe they add on at the new low of the day, and then they scalp out during 26. So they buy down here, they scalp out at 26, they make a couple points, they just take it. It's basically what smart traders are doing all day, and really difficult environment probably for stop order traders. 26, a bear bar closing near its low. Do you sell 26? You probably can. We're always in short on the close of 26 for sure. But it's really not very good always in short. It is always in short, and it's a credible always in entry. But I think that if you're selling 26, you're probably not going to get very good follow through. And the bad follow through is probably going to be very difficult to sit through. So if you sold 26, chances are you probably exited, somewhere above 31. I would imagine if a lot of the traders who sold 26 ended up losing that trade. So it's hard to sit through that kind of thing. 27, follow through for the bears, but again, not that ideal. It's a big tail on the top and the bottom. This looks like a leg in a trading range. None of this is trade of the day material. 28, a tail or a doji bar, a big doji bar. So not very good. Traders were not even able to trigger below 27. Again, still follow through for the bears, but the sell to close is likely going to come to an end. And so a lot of traders just exit at the market, and that causes 29. 30, a second leg down from 25, 26, 27. But overall, again, I'm expecting us to be more sideways. 31, a reversal up, a failed breakout below the wedge on 19. Bears see, bear trend 25, 26, 27. And this is a two-legged pullback, 28, 29, first leg, and 31, maybe 32, second leg. And they're hoping they get resumption down, which would happen. But that's not a very strong argument. I think that while we might go a bit lower, this really just looks like a leg in a trading range to me. So I'd rather wait. 32, follow through for the bulls. But again, you're at a loss from this follow through. So it's not very good follow through. And 31 was not able to close on its high. So it really wasn't all that good to begin with. And that's why traders exit disappointed. You get a bear bar closing near its low 33. Can you sell 33? Yep, it's a bear bar closing near its low, and we're always in short. The problem is this might be a trading range. And you can see that a lot of the traders who sold below 33 got a quick 4 points on 24, and they just decided to take it because quick money is hard to come by on these days, especially on stop orders. 35, an inside bar, a doji bar. Am I taking anything here? Not really. I think if 35 closed on its high, it was potentially a credible wedge if you can buy more lower, but you have to be willing to scale in a little bit there. I think it's really hard to take a buy above 35 if you're not willing to scale in, even if it was a bull bar closing near its high. And instead, it's a bear inside bar, right? So really not all that great. We trigger below it 36, but not ideal. This looks like, this looks like an area that we're probably going to retest. When you get this kind of breakout, but it's not very good, looks like an area we're going to retest. 37, a bear bar closing near its low. Can you sell? Yeah, I mean, we're always in short, and it's a bear bar closing near its low. It's okay to sell, but you can't be surprised when you take a loss on this trade. Let's put it that way. It's not a high probability trade. You're selling a breakout below a bear channel at a time where there's probably not going to be one. 38, a doji bar for the bears. So again, it's follow through for the bears, but it's kind of on par of buying above 15 and then seeing 16. It's just not the follow through you were looking for. You wanted a much better follow through bar, and you didn't get it. So that might lead to some profit taking rather soon. 39, good bar for the bears. They're hoping to get a consecutive bear bars, 39 and hopefully 40, but chances are they're not going to get it, and we end up getting a pullback on 40. 41, a bear bar, a bull bar, a low one short for the bears. But if you're selling below 41, you're selling a low one pretty deep in what's probably about to evolve into a trading range. So probably buyers below 41 instead of sellers. The traders who buy below it will just exit if 42 closes near its low. Instead, it doesn't, and more traders end up buying, and bears buy back shorts, and we get a reversal up 43. If you buy above 43, well, it's a credible midday reversal, and I think that the magnets bar 3, bar 11 are going to be important. I was obviously wrong today. They didn't end up being that important. But I thought that buying above 43 made a lot of sense, looking to get to the bar 3 close or the bar 11 close. And we instead got disappointing follow through 44, and we never even triggered the buy above 43. So inside bar 44, a high one for the bulls. Okay to be long above 44, essentially acting as if it was the buy above 43. So I think okay to be long as 45 triggers above here. 45, a bit disappointing. It was an II for most of the trade, or for most of bar 45, so it was an inside bar, which would have made 44, 45 an inside bar and a potential final flag for the bears. And instead, we ended up getting more follow through for the bulls 46. Another bull bar closing near its high 47. 47 is a bit climactic and a breakout attempt above the channel, 45, 46. So it's definitely a climactic bar on 47. I think this is easier displayed on a lower time frame. That 46 and 47, or sorry, 45 and 46 is a channel, and 47 is breakout above it. Because you can draw the channel line, but it's hard to see without the actual. So yeah, you can see channel and then breakout above. So it's not as clear as I wanted it to be. Sometimes it is. Yeah, you could say, channel here and then pull back and then breakout attempt above the channel. So it's not as good as it could be is the point. So while it's a good bull bar 47, yes, buy the close, yes. You just have to keep in mind we might start to pull back soon. But I think it's a credible buy because sometimes when you have magnets above, the market will just vacuum test those magnets rather than going more sideways first. 48, a doji bar. Credible follow through for the bulls, but we're getting a lot of follow through today that ends up being doji bars, and it's becoming mildly disappointing. 49, 49, more follow through for the bulls, but again, really not all that good. It's an inside bar and a high one, so it's credible to be long, but you want some reasonable follow through rather soon. Bar 50, and I think 50 is pretty disappointing. Bulls wanted to see a bull bar closing near its high, and for a lot of bar 50, it was a bull bar closing near its high. And instead, we get a disappointing bar 51 with a big tail on the bottom. 52, it's follow through for the bears. They're arguing maybe some sort of parabolic wedge, 43, 47, and 50, but it's really not all that good to sell below bull bar 51. I thought that bull bar 50. I thought we might get a second leg sideways to down, which could have been, 50, the tail on 50 could represent the pullback, and the second leg sideways down could be 52. And then we get the reversal up 53. I thought that was credible, but overall here, we might end up being more sideways. I thought 53 was a pretty credible buy, looking to get back to maybe the 15 high, the 11 high, the 3 high, somewhere up there. And whenever you get a credible buy that immediately goes against you, traders are surprised. And when they're surprised, a lot of traders end up getting trapped, and that can lead to really fast moves. So the reason that, in my opinion, the reason that we got the move 55, 56 was because traders buying below 53 were expecting to make money. And they were disappointed with 54, or they thought it was at least 50-50 that they were going to make money. And they were disappointed with how strong 54 ended up being, and a lot of them exit causing 55. And then a lot of the traders, even then, who held below 54, betting that 55 was not going to be a strong follow-through bar and that their premise was still valid, are now really shocked that we got a second strong close on 55. And so they all panic out, and that's what causes 56. The problem, well, first off, 54, double top, 50, and neckline 52. So at least a 40% chance of a measured move down. So selling below 54, at least 40% chance that we're going to get somewhere down here. Might be more like 50% since it's a trading range. So 50-50 bet, selling below 54, risking, 4-ish points, trying to make 6.5. So a reasonable trade if you expect to win half the time, but not really a great trade. But anyways, 55, like I said, follow through from bulls exiting, and now there's a lot of bulls trapped. That's why we get a micro gap down 56 and a huge bear bar closing near low. But at this point on 56, it's a really climactic bar, and you're selling against a small pullback bull trend day yesterday. So what's more likely, this being a vacuum test of some sort of resistance, or this being a giant new bear trend? Could additionally be a big wedge, 639, 56, but I think that the important reason to not sell 56 is because it's where all of the final bulls sold out of their longs as 56 was forming. And the strong bulls will probably start to buy. And for bears, the sell was 54, 55. 56 is a profit-taking bar because traders are just happy they made that much money. Same way selling below 33, and traders got quick money and they exited 34. It's a similar concept when you see 56. So reversal up 57. And as silly as it sounds, buying above 57, like I said earlier, you can see that 53 was a reasonable buy. So if you bought above 53 and you added above 57, 80% chance we're going to get here. I would say that we have a trend line break, and then a lower low major trend reversal 57. Lower low major trend reversals generally need a higher low before they can start the rally. And I thought after 54, 55, 56, it was even more likely we were going to need a higher low, which I think 61 was the higher low. You can see it traded below 60. But anyways, 58, follow through for the bulls. Good for the bulls, probably going at least a little bit higher. 59, doji bar. Some follow through still, though. Still a bull bar, and then an inside bar, high 1 on 60. So high 1, 60, probably buyers below. Sends 3 straight bull bars. 4 straight bull bars, and probably a trading range. And then 61, a bull bar closing near its high. A higher low major trend reversal 57, and then the higher low, lower low major trend reversal, and then the higher low that's necessary on 61. We still have an open gap with the 57 low and the 61 high, which makes this a little bit stronger. 1 second. The problem is that you're buying against 3 really strong bear bars, and you're buying right on the moving average, but bulls have an open gap, a credible higher low major trend reversal. And so I think okay to take the buy above 61 and probably just put a stop right below 61. It might make sense to scale in, but I'm not all that sure. 62, disappointing follow through right at the moving average, but traders, instead of selling out of their longs, you can see when you got to the 61 close during 63, what did traders do? They bought more and we closed above it. If this had closed below the bar 61 close, it would mean to me that traders were disappointed enough in how 62 closed that they no longer want to be long, and that caused 63. Instead, traders were considering that they still thought they were correct. They thought their premise was still valid, that we were getting back to the 53 low since 60%, or so the 53 high since 60% chance that that price will be retested. And so they still thought it was valid to be long, and they continued to buy more at that price. That's why they got good follow through 64. It's buy the close, more follow through 65. I thought we might start trying to rally up towards the 11 high, but I thought also that if we were going to do that, we may have already done it earlier in the day. And then bear bar closing near its low 66. a lot of bulls will exit below 66. We probably need a second leg sideways to up, which we did get on 68, but it's really not all that ideal. So 67, follow through for the bears, but a doji bar, not as good as it could be. And then 68 trades above 66. So stopping out weak bears who sold below 66, stop above. Some traders might sell below 66 and put a stop, a measured move above 66 and add on, but I would not do that. I think that's too difficult, and you're trading against the always in position. It's okay to do things like that when you're trading with the always in position, like, I'm trying to find a good example. I don't know. That's not really that good. I don't know. There weren't a lot of good examples of that today. But anyways, 60, but I would not buy 68 because you're buying way too high in what's probably just going to be a trading range. I'd rather wait to see if 69 is a good follow through bull bar. And 69 is a bear bar closing out slow. 70, a bull bar, but probably not worth buying. There were sellers at 68 low, as we can see. And then we basically just went sideways for the rest of the day. Once we start to see 69, I think the bull trend is over, and it makes more sense to just wait and see what we get. If we get some sort of consecutive bull bars rather quickly, it might be worth taking the buy, but for the most part, I would just be done for the day. For stop orders today, it was pretty tough. I might have this backwards. I'm not overly confident on anything today, but I would not sell 13 because of how often the bulls have been buying the moving average and how strong of the bull bars we'd gotten. I thought there was a lot of problems with it. 15, there was definitely still problems with, but I thought at least, bulls had some better arguments going for them. I thought 18 was tough, 26 tough, 33 is probably fine, 37 is tough, 43 doesn't trigger, but it's fine. And then 40, 46, 47 is by the close. I thought 53 was a good trade. You probably just take the loss pretty quickly below 54 or, bullet, just obey your stop below 52. But I thought it's credible. You're probably going to get some sort of follow through and at least a second leg sideways top. And the 2-to-1 of your risk reward is at around the midpoint of these two prices. So I don't know. I thought there's a reasonable enough chance that we're going to test up to here. I thought, when you see a bar like 53, I thought maybe 40% chance we were going to get up to here. But in trading range days, a lot of times 40% is more like 50. So I thought it was reasonable to buy above 53. You could sell below 54, but I thought aggressive. And then it's back to sell to close. 55, 56, probably more, take profits rather than sell to close. And you can buy above 57. 61 is good, 64, and then I would be done. I thought the best limit order trades on the day, probably buying below 41 made sense, and you could probably buy below 60. I thought 60 was probably the better one, and that would be that. The daily chart, bad follow through for the bulls, so something disappointing. You can see we got a couple legs sideways to down. Now we have one pullback, 2 legs up. It might be pullback, and then maybe we get a third leg up. But ultimately, the upside is probably relatively limited here. Tomorrow's the last day of the week, right? Yeah, tomorrow's Friday. And, bears are going to try and put a big tail on top of this bull bar as they can. But ultimately, even if it closes on tie, I think we're coming back to the April 27th high relatively soon, probably the following week or the week after that. I don't think this is a new bull trend. I think these huge bear bars started a trading range. And this is going to end up evolving into a trading range. That's it.